Hi, everyone. Thanks for joining us to hear about the common tax due diligence issues on private transactions. I'm Jenny Nguyen, a director in our private deals team here at PwC. I'm pleased to be joined by Lior Pregan, who is a partner in our private tax business. So, Lior, paying tax and more importantly, paying the right amount of tax is critical for any business. Why is tax compliance important for businesses thinking about a future sale or purchase?
Thanks, Jenny. Well, as part of any buyer or investor's due diligence process, tax will be a key focus area, and if not properly managed, can quickly result in an erosion of value. The tax due diligence process can be intense, and it is intended to identify any material risks or exposures that a buyer may inherit across the spectrum of taxes. For many private businesses, this will be the first time that the business is reviewed for tax in this level of detail. And from our experience, if the tax risks in the business are not known and preemptively managed before going through the exit process, there can often be leakage in value. This is either because bidders adjust their price to factor in tax risks, or because of the advisor costs incurred during a live deal process to resolve those issues. So getting a handle on the tax and compliance affairs of your business before a sale process is absolutely critical in advance of any sale. A buyer, as part of their due diligence, will want to ensure that the tax control environment and management of tax risks is proven. Companies with a track record of proactively managing their tax affairs, lodging returns on time and making payments on time, and positively engaging with revenue authorities will immediately engender a greater level of confidence and trust.
But it's more than just compliance, isn't it, Lior? What are some other things a business or founder should be thinking about when looking to get ready for a sale?
That's right, Jenny. For many private businesses and their shareholders, who are often founders and families, an exit or a sale is truly a once-in-a-lifetime event. And you really want to make sure that you are set up for success and that you're able to fully maximize value for your legacy. Some of the things we want to be thinking about before a transaction include, firstly, is my business structure set up appropriately to facilitate an exit? And is it investable from a buyer perspective? As an example, some investors, particularly those from overseas, may not be comfortable investing in trusts or partnerships. And so if the business is operated through a structure like that, you should be taking the time in advance to identify whether preemptive restructuring is needed. Secondly, are there any assets in the business which are non-core, which will need to be excluded from the transaction perimeter? If so, identifying those assets early and having a tax-effective plan of how they will be carved out before engaging with buyers is important. We are often brought into a transaction late in the process where the commercial terms are largely agreed, and this makes any restructuring in sort of the context of a live deal complex. And thirdly, are your personal holding vehicles and structures set up appropriately to ensure that you are effectively managing tax and wealth? Early wealth and legacy planning for private businesses is important and should be thought about early.
So it sounds like getting records, documentation, and other tax-related items into place should be a priority.
Yeah, it absolutely should be. I've lost count of the number of transactions where tax has either held up a deal or resulted in value loss. Having said that, it also needs to be understood and accepted that no business is going to have an absolutely clean sheet when it comes to tax, and that there are likely to be risks in any business. But the biggest recommendation I can make is to take the time early to engage with professionals to identify what those risks may be and to proactively manage and resolve them before going into a sale process so that there are no unwanted surprises.
What are the common areas where private businesses might expect to fall short during tax due diligence?
Look, Jenny, it will really come down to the nature of the business and the sector and the structure you have in place. Based on our recent experience, some of the common tax due diligence issues we see and which can have a value impact include firstly, the incorrect treatment of workers as independent contractors instead of employees. And this is particularly from a superannuation guarantee perspective and payroll tax perspective. The ATO and the state revenue offices are very focused on contractor classification. And so if you haven't had a look in a while at your policies or processes, it is important that you do so. Secondly, and for high growth private businesses, the incorrect application of turnover aggregation rules, which means small business concessions such as a reduced 25% corporate tax rate or enhanced R&D incentives may have been incorrectly claimed. And thirdly, expenses of a personal nature being claimed as deductions within the company or personal use assets such as properties and cars being held by the company for use by the shareholders.
And what happens if, in getting ready for a sale, a vendor finds an issue?
Look, this isn't uncommon at all and is part of the reason why you go through the process. Getting ready for sale early helps provide enough time to find and address those issues so that the impact is known and steps for rectification can be agreed. It's good to get this out of the way before you start the deal process, as finding issues during diligence can create uncertainty and noise, which may ultimately undermine business value.
Thanks for the insightful conversation today, Lior. From our discussion, there are 3 key takeaways I'd like to highlight. Number 1, timeframe. You've given us a few key items that need to be in order, and preparing early is key. Number 2, be able to demonstrate that you've met your obligations. Businesses should have good records to validate their tax compliance and that their control environment is strong, especially in the last 4 years. And number 3, road test your structure. Make sure it not only works for you now, but it's also investable and provides the most tax-efficient exit for your transaction process. Thank you, Lior. Thanks for watching and see you next time.